Hi everybody, my name is Mary Redmond. I'm talking right now about the pound-dollar pair. So I've been looking at this pair for a couple of weeks and I've held a short bias on it, although I don't think that the pair has really made the break that it could make over the next couple of weeks. And there are several reasons really why I still have a bearish bias on this pair. It broke out of its year-long upward trend pattern that had been in place really since last May. And we have a downward channel on the pound, it's really pretty strong. I mean, this downward channel, it's a strong trend that is likely to continue unless something dramatic changes in the fundamental situation for either of these two pairs. And I also think it's got some very strong support right underneath the level it is now, about 59.25 to 58.80. And if it were to break that level, I think that we could see another 200 to 300 pip drop down in the pound-dollar pair. So looking at the fundamental situation, we really got a move towards risk aversion this week, particularly in the euro and to a lesser degree in the Australian dollar, at least so far on Friday and Monday. And there was some weakness in the US dollar following the employment report, which was weaker than expected on Friday, but that hasn't really had much of an impact, and the reason for that may be just due to the fact that market participants aren't really expecting extraordinary growth on a month-to-month basis in employment in the US. I think a long-term cycle of slow but steady employment growth and subpar economic performance in the US is kind of expected and priced into the markets. And there's some speculation about additional easing measures which could be taken by the Fed, but I'm of the opinion that they're probably not going to do that because they always like to save some of their ammunition for a truly extreme situation or an emergency. And Bernanke was pretty clear in his last testimony that the circumstances are very different than they were last August when they started talking about QE2. So really, despite the disappointment in the non-farm payroll report last Friday, nothing has really changed that much. But the dollar is still the currency which is preferred most in periods of rising risk aversion because of the liquidity factor. It's always easier to buy and sell dollars than almost any other currency on a short-term basis. And you can see that you could look at this as a possible bullish wedge. There's resistance right around the present levels. You can also look at the dollar index as a slow upward moving channel that started in May. But really the most important news of this week is surrounding the European sovereign debt issues because of the bond yield spread up, which has now started in Italy, which is a much bigger country and could present a lot more problems down the line for the EU. I mean, the smaller countries like Portugal and Ireland and Greece can receive bailout funds from the European Financial Stability Fund, but if one of the big countries like Spain or Italy would have problems in the debt market, I mean, you could be facing more serious problems. So that's really what the market is focusing on right now. And the pound hasn't really made as much of a big move down as it might, although the pound does have exposure to some of these countries in terms of sovereign debt. They have a minimal exposure to Greece. It's only been estimated that the UK banks have about $4 billion in exposure to Greece and a minimal amount also to Portugal, but they do have a very high exposure in the range of $225 billion to Ireland and $150 billion in exposure to Spain. So that could be a real problem depending on how this contagion spreads. And these UK banks might be taking some big losses. And because they're not contributing to this European Financial Stability Fund, they may not get first lien on whatever assets are divided up. So it's just the start of what could become intense problems. And the reason that the pound has held up, or one of the main reasons the pound has held up over the last few months, was the inflation rate in the UK and the fact that there was an anticipation that at some point the Bank of England was going to have to raise rates. So this week could be a very decisive week because if the consumer price index for the UK comes in slightly lower than expectations, which it might, then the markets might actually start to think about additional easing measures from the Bank of England if the economic situation were to become particularly grim. And if there's lowering inflation, which some of the analysts and the Bank of England members have said is possible, then the expectation for any type of rate hike is probably going to dissipate. And if we have further risk aversion in the stock markets go down, then we could see a bigger move down in the pound. So we're also going to see the beginning of earnings this week, and that's very important to watch because the stock market did make a move down over the last 2 days in the range of 2% on both the Dow and the S&P. But the earnings, nobody really knows. You can't predict. And personally, I felt that there's going to be a move towards risk aversion, and I think that companies may be lowering their estimates going forward. But the real move may not happen until the third quarter of 2011. So we don't know, and I wouldn't make a big bet that earnings are going to be particularly weak or particularly strong, except with the possibility in the financial sector, in which the earnings are probably going to be weak. But if we want to look at the S&P 500 here, we started to have a move towards risk aversion here in terms of the pullback. But if we get excellent earnings, we could start to make a move up again. So again, one of my most important and favorite indicators for watching all of this for the market's appetite, fear, and greed is the volatility index. And last week this turned out to be a good short for the risk-based currencies, even though the commodity currencies haven't fallen that much yet. And what we're seeing now is a level probably not at which we want to buy the riskier based currencies, but at which we want to be a little bit cautious because it shows that volatility is spiking up. And I would say if there were a move to above 20, maybe to the 22 to 25 level in the VIX, then I wouldn't want to be short these riskier currencies. I'd either want to take a step back or else consider taking a small long, depending on the situation. But for the moment, I favor the downside in the pound, and my analysis is based on simple downward channels, simple technical indicators that are crossing to the downside. You can see that both of these Ichimoku lines are moving down. There was a big cloud resistance up here, which it has cleared. And there's really very little supporting the pound right now, and there are a lot of problems. So I think it's possible we could even see a move to $1.55 depending in the next few weeks, depending on whether or not there's any intermediate term resolution to the European debt issues. And of course, there's always something they can say. The politicians there can come out and say, well, they're going to add more money to the Financial Stability Fund, or they're going to work out some other type of rollover. But it still means that some of these banks are going to be taking losses, which is going to put a drag on economic growth going forward. So that's my take on the pound, and I would particularly watch the consumer price index, and if it comes in lower than expected, I think we could see a move downward in the pound.